Welcome in, everyone. This is Dan French. This is the Real Estate Channel Network. Thank you for making me part of your day. Today, we're going to talk about FHA, or known as Federal Housing Association. And is this loan for you, right? If you're out there buying a home, would you be the one looking at buying with using an FHA loan? Now, county limits do increase year over year. When you look at supply and demand, it's really about, do prices of homes on average keep going up? Ever since the collapse of 2008, prices have been going up across the country. So we've seen increases in county limit for FHA loans. Now, the Federal Housing Association, which was created back in 1934, really during the Great Depression, why was it created? Well, there was a housing crisis. We really had a freeze in housing. The only way you can get a loan back then was 50% down. It was a 5-year balloon loan. You would hope to maybe refinance out of it before that 5 years hit. So the government had to do something. So they stepped in and said, let's go ahead and try to, maybe we can give a loan by putting insurance behind it. And so that was the catalyst behind how FHA loans got started. Average middle class working Americans that needed to buy a house that couldn't, they didn't have the 50%. Again, we're talking about the Great Depression, World War II. It was a complete housing crisis. They came in and stated you could put less money down because now we have insurance companies or insurance to come in and help with, if the insurance or if the house was defaulted, the insurance would pay off that loan. So that's where FHA was started. That's when it was created. And ever since then, it's been a great tool for Americans, even up till today, to buy a house, putting down less money. So over the years, longer term mortgages, less money down, fixed monthly payments. A lot of Americans like that. Access really to home ownership if you're average middle class American out there. Let's talk about FHA and some of the things that they require, and maybe some of the leniency, some of the things that are restricted based off FHA loans. FHA, the loan requirements are 580 plus credit score or higher if you want to put down 3.5%. You could still get an FHA loan at 580 or less, all the way down to 500, but you would have to put down 10%, right? Putting down 10% doesn't necessarily mean you're going to get approved. It just means that you have the ability to still buy if your credit score is not very good. There is other considering factors. Risk threshold. We look at underwriting overlays and considering factors based off of, let's say, your income. Sometimes I've had people where they had to buy less of a home because their risk threshold was still too high, based off of even having a 580 plus credit score, putting down 3.5% or even putting down 10%. Now, people out there that are at 500 or less, unfortunately, you're not eligible for FHA financing. And at some point, you have to look at it and go, well, maybe I should take this time and work on my credit, work on saving money, work on me being in a better position to buy a house. That's what I see with a lot of FHA buyers out there. Again, there's a game plan I could put together for you. I have people associated with me that can help you with that as well. I'll have a link to all this information. So if you guys want to reach out to me, definitely do so and we'll help you. So let's go back into this. At a $400,000 house, purchase price home today, 580 plus credit score or higher, your down payment requirement is $14,000. Again, that doesn't necessarily mean you're going to approve always for the house that you want. There's considering factors. Now, if you're at a 580 or less, look at the significant difference in down payment requirement. You went from $14,000 all the way up to $40,000. But at least you could still buy a home, but there's considering factors. Now, where does the money come from? Okay, what's great about FHA is you can use your checking account, your savings account, even down payment assistance. You can even use some money towards that. You could put towards getting a down payment assistance program in place where they can help you buy a house. Other than that, you can get a gift fund from a family member. All of that money has to be sourced. I've seen a lot of people either have problems at the end because the money was in different banking accounts, it wasn't sourced properly or seasoned properly. So you have to understand this is very important, especially through an FHA underwriter, to have seasoned money sitting in an account, and it could be sourced from one of those areas. Now, let's talk about FHA allows higher debt to income ratio. Okay, they do offer higher debt to income ratio, which is more lenient, say, than other loan programs out there, especially for primary residence buyers. Now, what do they look at? FHA allows you to go up to 47% on your back end, on your front end ratio, and your back end ratio at 57%. So, what does that look at? Well, 47, the front end, I've seen it where 42, 43% is pretty standard. Other considering factors and risk threshold, you can go all the way up to 47% on your front end, which is really what your current debt or your mortgage payment is based off of your current income. And then on the back end, it's 57%, which is very high. At that point, you have to think almost 60% when you include everything plus your mortgage is all going to either debt or some obligation. And you don't want to be mortgage broke. Now, more back end ratio shows the percentage of your gross monthly income, which goes towards paying all your debts, mortgage, rent, car loans, student loans, credit cards, insurance. Just like I said, that's the considering factor when it comes to FHA's underwriting. Now, when you look at, I always talk about mortgage insurance premium, or they know it as MIP. Mortgage insurance premium automatically falls off after 11 years if your original down payment was 10% or more. That's a very big key factor. You have to put down 10% or more at the original amount. If you don't do that, then you're going to be paying mortgage insurance for the life of the loan. Now, what is difference in requirements when on the properties themselves? I've seen properties that were very distressed, not working order, not get approved for FHA. They go through the appraisal part and they find issues with it, and it doesn't meet FHA requirement guidelines. FHA wants a home in working order. FHA ensures properties must meet strict minimum property standards set by HUD, Housing and Urban Development, focusing on safety, security, and soundness, meaning housing needs functional heating, plumbing, electrical, safe access, sound structure, roof foundation, and be free from hazards like peeling paint or infestations to qualify for an FHA loan. That is very important, because everybody out there that thinks just because you get approved for a loan, there is many layers to going through a process to get an FHA loan. And I've seen a lot of people, if it's not properly structured up front, they're not meeting the requirements, or at least have the underwriting address those requirements or maybe conditions or concerns up front. Potentially you're putting yourself at risk of losing your earnest money deposit. Guys, that's it. If you have more questions on FHA, I'm going to have a link below that if you guys want to fill out an application or get help or support on FHA loans, some of the requirements, additional requirements that we didn't discuss in this video, reach out to me directly. This is the Real Estate Network channel. I'm Dan French. I will see you guys at the next one. I'm out of here.